Hey everyone, I am back with the godfather of income investing, Stephen Bavaria, author of The Income Factory. How are you, Stephen? Welcome back to the channel.
I'm I'm fine, Adrian. It's a pleasure to be back. Thank you.
So happy to see you again. So last time our internet connection was a little off, it was a little bad, so there was some interruptions, but now it seems like we're good. So hopefully we'll have a great Q&A and I'm talking to my audience here. We already did one if you want to go back and check the first one where we talk a lot about your background, Stephen, how you came up in the industry, etc. We're not going to go into that now. We're going to talk more about current events since we already covered that if you don't mind. So first question off the bat. Trump won markets all time highs, right? So as an income investor, and we'll dig deep more into the psychology now of your mindset. Are you still buying more every month if the markets are all-time highs? What do you think about that?
Well, the market for stocks are at an all-time high,
That's what I meant.
and my philosophy is to try to emphasize income. So I do a lot of credit investing where I get high yield bonds and senior loans and business development companies where I'm collecting interest essentially of 9, 10, 11%. When I buy funds that invest in CLOs, we're even getting 14, 15% and higher yields. Now that won't last forever. So I'm looking to interest and predictable payments, not so much capital gains like you would look to in an equity growth strategy. So I don't know whether that will be impacted, how that will be impacted by the new administration and what it does. But I am a little concerned if I were a stock investor, which I own a little, but I mostly own utilities and high yielding stocks that are consistent with an income factory philosophy. So I'm not too worried about it being a top, for example, because I think that my sort of steady monthly income is going to continue pretty much no matter what. I'm betting on corporate America or corporations generally, but most of it's corporate America to do well, to stay alive, pay its debts, and therefore make credit a good investment, no matter what happens to the economy. We have senior executives and CEOs who run our companies who've got so much skin in the game that even if the stock market crashes and the stocks in their companies that don't do well, they're going to do everything they can to keep their companies alive, and that's what I'm betting on as a credit investor. So I feel I'm kind of hedged to no matter what happens to the economy under our new administration.
Interesting. I feel the same way. So that's in terms of psychology, I think we're right on point. Our mindsets match completely. I think the main difference between us is really what we invest in. You're more in the credit market, like you said, with those mostly closed-end funds on the U.S. stock market, which has a humongous market. In Canada, there's like four of them or something, or 25 if you include the split funds, but I don't want to get into that now. But yeah, exactly. I feel the same way, right? As long as, I invest more and pretty much exclusively in equities with covered calls. So I feel like that is really the protection. Are you worried at all about, I know, I probably know the answer, but are you worried about some sort of market correction, market crash, market recession? We know that these predictions are always being floated pretty much every year, and 99% of them are wrong, of course. Are you worried at all about any of that?
I'm aware that let's say I'm concerned about it, not so much that not as much that there's going to be a market crash, but I'm equally concerned about what the administration might do that would cause markets to crash, that would cause a recession or whatever, because we've had the president elect as a campaigner say he's going to do certain things like deport millions and millions of people or put tariffs on all of our imports, which would be like a big sales tax on a huge percentage of what ordinary Americans buy all the time. Those two things could really disrupt our economy if he does them. Now, will cooler heads in the administration prevail? And would any tariffs that are put on be more selective, for certain countries or certain goods where we really have a problem, where someone's taking advantage of us? That I wouldn't be so concerned about hurting the economy, but a tariff across the board. I mean, in 1929, it was tariffs by various countries, protecting, quote unquote, themselves from each other that triggered the Great Depression. So I would be concerned about a crash that was instigated by across the board tariffs, which turned into a big sales tax on so much of what we do, as I would be a recession that would be caused by the disruption of having millions of immigrants who are here, whether they're here technically legally or not. They're doing an awful lot of the work that is done in the construction industry and the in landscaping and all sorts of other things that could crash the economy or contribute to crashing the economy if you had all this labor force that was all of a sudden scared away or taken away, and therefore was not available to work. So I'm concerned about that, and therefore I'm investing, as I said, in credit where even if the economy crashes, you have a sort of predictability about the default rates, which then translate into loss rates, which are much lower than default rates because investors get a big chunk of their principal back. So if you have a default rate, if you have a recession level of defaults like 5 or 6%, you're going to have then losses of maybe half of that, because on most defaulted loans or high yield bonds, you get back between 40% and 70% of your principal. So your loss is only 30, 40, 50% of the default rate. So even with a recession level default level rate of, who knows, 5%, 6%, even a horrible recession like we had 15 years ago, it got up to about 10%. You're only talking, I say only, it's relative, but you're talking about then a loss rate of 4 or 5%, and losses of 4 or 5% on credit portfolios that are paying you 10% just in interest each year means you're not even going to touch your principal. You're going to lose half your interest. So you'd have a 5% return on it instead of 10% one year. That's going to be so much better than what's happening to equity investors in the rest of the economy, that I'm not, I think I'm prepared for the worst is the way I'd look at it.
Interesting. Yeah, I have the same. Well, I think we're different in a couple of ways. You know that I'm fully invested in pretty much equities with covered calls, so I don't think and mostly, honestly, if you look at my portfolio as a whole, it's like 90% the S&P and the Nasdaq indexes. With covered calls, different strategies, but those are the assets. So personally, I think Trump is pretty much the most pro stock market president in a while. When it comes to the immigration, I think that's completely overblown. I don't think some sort of mass deportation of illegal aliens is going to impact Apple and Amazon and Google and Tesla. I'm mostly, in the large caps. And also I got covered calls on them too, which I'll ask you a little bit about later. What's your opinion on that? Because I know last time we discussed that you started dabbling into more equity covered call stuff. So I'll ask you about that a bit later. Question I get, you probably get this all the time, the income style, the income strategy, whatever you want to call it. Is it only good for retirees, or do you think it could be good for everyone?
Yeah, that's a good question. I think it's particularly good for retirees, but I'll go back and answer the first part of it. If you're a 25 or 35 or 45-year-old who still has 20 years, 30 years, 40 years to invest before retiring, your target is to earn an equity return of 8, 9, 10% per annum. I mean, a lot of people who choose to try to beat the average equity return end up doing worse than it,
Yeah.
because they decide, they look for entry points, they move to cash, they're often out of the market. I call it like being on the platform when the train takes off and leaves the station and they're not on it. When equities start up again, there's no conductor who blows a whistle and says, hey, everybody back on the train. So statistics have shown over many generations that the average person cannot beat the equity average. So a few can, but most will not. But by trying to beat it, many of them do worse. So if your goal is to make that 9 or 10% on average over the next 30 or 40 years, whether you do it with an income factory approach where you own instruments that pay you 9, 10% per annum, and I'm assuming you're, say, in an IRA, which most long-term investors do most of their retirement income saving through tax-deferred vehicles. So being in something that pays you 9, 10% interest or dividends and never grows, and you create your own growth by reinvesting and compounding at 9 or 10%, or being in a stock portfolio like the S&P 500 pays a yield of about 1.5%. So you're betting there will be another 7 or 8% in capital gains on average each year. Being in either one, even if you get those capital gains and you get the 9 or 10% total return on the equity portfolio, you're going to, in both cases, the math is the same. And as long as you're compounding and reinvesting your total return, whether you get it in cash and physically reinvest it or drip it, or whether it's internal in the stocks themselves and they're growing 7 or 8% internally and you're reinvesting the little 1.5% dividend you get. Either way, the math gets you to the same place when you're 60 or 65. Once you are starting to withdraw your pension from yourself, you're creating your own pension, essentially. Once you start to withdraw it at 65, 70, whatever, first of all, you still have to keep thinking long term, because the average person who reaches 60 or 65 lives to be 80, 85, 90, or even more in some cases. So you've still got to take a long-term approach to investing what's left while you're taking some out each month. And that's the point where you run into what they call sequencing risk. If you're only in stocks where you're counting on capital gains to give you your incremental growth, those years where there are no capital gains, but you're retired, you still have to take money out of your account, which means you're then selling stock at lower prices. And so your capital is being eroded because you have to take the money out at the wrong time, but you have no choice if you're retired. That's called sequencing risk. If you're in an income factory, or you're sort of an income approach where your capital is creating the income, and you're taking some or all of that income every year, hopefully just some of it so you can continue to grow a bit, you're not touching the capital. So if the capital goes down in a particular year, you have a paper loss. You don't have to convert it into a real loss because you don't have to touch it. You just take out some of the earnings from it, but you leave the capital to keep on growing it and keep on producing it. And then if the capital, your capital can hopefully go back up the next year, but that you don't have that risk of having to sell at the wrong time. So I'd say an income factory or your income approach is a real advantage once you're retired and taking money out. But until you get there, either approach will get you there equally well. It's whichever one allows you to sleep well at night and stick to it, so you don't panic and go to cash or anything like that.
That's a lot of great points to unpack. We agree on a lot of the stuff you said. I typically call what you call the sequencing risk the drawdown risk, right?
Mm-hmm.
I guess it's another term for it, where and this is why I feel the income strategy really shines. So if you just, instead of taking the S&P 500, you go with an S&P 500 covered call strategy where you're already pumping out. It's the same concept. You don't have to sell your shares, whereas the guy who's holding, or the investor who's holding the S&P 500 has has to draw down, and then we get into that whole 4% rule to make sure. And that's all something, it could stress you out because market crashes, you see your capital go down. It's just you avoid all of that. And I also feel like, it doesn't the way I explain it is, and let me know if you agree with this, an income type of ETF, whether it's a closed-end fund that spits out 8, 9, 10, like you invest in, or a BDC, et cetera, or something like I do, which it would be an index-based covered call ETF, a NASDAQ 100, there's Russell 2000, there's S&P 500 with covered calls, you're getting, between, depending on the fund strategy, but let's just say 12% annual yield. You could turn an income ETF into a growth ETF by, like you said, just turning the drip on in your account, right? But you cannot turn a growth ETF like a regular S&P into an income factory. You have to switch, or you have to draw it down. So what do you think about that? I think that's pretty much one of the major advantages. The consequence is you're not dependent on what the stock market is doing as much as a growth investor who's fully in a growth ETF, right? What do you think about that? Would you agree with that?
I think either one of our strategies avoids that risk we talk about, whether you call it drawdown risk or sequencing. I use the term sequencing because I only learned it for the first time this past year. I'd never known what the risk was called, and I saw it. But whatever you call it, either one avoids that risk. And I think that's the important thing. I don't know as much about covered calls as you do, but to the extent that by taking a covered call, you take a growth stock, let's say, and then you take a covered call strategy to it. My understanding is you're trading off some of the potential, or maybe all of the potential for growth, to get a premium on an option that basically converts that into a more predictable income stream.
Exactly.
And that makes total sense to me. And to the extent you only want to do the option, optionalize, if you will, a portion of the potential growth, then, I mean, you can do a blend where you keep some of the growth, but you don't have as much risk as you'd have if you didn't, do a covered call at all. So it seems to me your strategy gives you a great deal of flexibility to tune the strategy to the risk reward comfort level of your individual investors. Some may just want to use covered calls for a portion of it and keep most of it open to potential growth. Others might want the other way, where they say, I'll trade away all the growth for this, for the predictability. But I think it's great that you have that flexibility so that you can apply a strategy like this to a whole range of investors with slightly different levels of their risk reward comfort level. Now, I think you can also do that with an income factory by what you choose, whether you choose to do part of your income factory with equity closed-end funds, because even an equity closed-end fund, which converts its growth every year into an income for you, you're still dependent on the underlying assets in the fund to have some growth. If not, then you've got what you call a managed distribution, where you're borrowing from future growth to pay a distribution today, which works for a month or so, but not for a period of years. So that's a long-winded answer, but I think we're both on the same track.
Yeah, and this is where stock, you could actually do your own cover call strategy. You could buy Google and Amazon, and you could buy all the stocks you want and sell calls on it, but you need to do it in blocks of 100. I just invest in the covered call ETFs, where the fund managers are way more skillful than me. I've never sold a call in my life, even though I know exactly what they're doing. And this is where you pick and choose the one where you feel most comfortable. Some are giving up a lot more upside, some very little upside, and typically the yield is a big giveaway. If the yield is 8-9% on the S&P 500 with a covered call strategy, you're not giving up that much upside. But if the yield is 12-13, you're giving up a little bit more, and so forth. So this is where you got to dig deep, understand what the fund manager is doing and the key to the whole cover call strategy is you have to determine the degree of upside you're giving up, and if that matches your goals, your perspective. But what I really love about it is the flexibility, like you said, because even if you make 12% or 13% or 15%, that comes to you as cash and you decide what to do with it every month. If you don't need it, you only need half of it, you reinvest it, you got more units. So you're actually growing that way.
Hmm.
Like you said, you're trying to, the goal should always be long-term mindset and reinvest as much as you can. So we're definitely on the same page. So yeah, we talked a little bit about the covered call equity funds. So just from me to you, I highly recommend you look into it because I feel like it's genius because it allows you to stay invested in the top performing asset class equities with lower risk, but you're still getting a lot of that performance. And now, like like we talked about off camera, there's so many of these covered call ETFs. Some are more exotic and sexy than others, and some of them now are not only really close to the total return and performance of the actual indexes, but some of them are actually beating it, which is just
Hmm.
mind-boggling to me. And then some of them have weekly distributions now, some of them
Oh, right.
monthly. Some of them are targeted at 20% a year. There's all kinds of options. It just depends what you feel most comfortable with, and you can combine options as well. I'm just curious, Stephen. Bitcoin's been in the news lately. Crypto, MicroStrategy. Trump is a pro crypto president, or so so they say. Or it's been on a tear. What's your opinion on Bitcoin? Just like that.
Well, I hate to have an opinion unless it's an informed opinion. And
What do
I'll
you
be the
feel
first.
about it?
Yeah. Well, first of all, I don't understand it enough to say that I have an informed opinion. And I don't believe in investing in things that I don't understand. But having said that, from what I understand about conventional currencies, the value of a currency comes from the fact that there's a government someplace that will treat it, will give you credit for it. If you're a citizen, for example, that you can pay your taxes with US dollars, that you can take your, whatever the currency is, you can take it to the government or to local banks and actually be sure that you can convert it into other currencies or that you can use it to purchase things, that you can use it, you know, to spend, whether to pay your bills, pay your debts, or acquire things, real estate, whatever. A currency or a so called currency that only has value to the extent that someone else in the market will pay you X for it, but where you don't have any established authority that's giving you the value, that's, you may have all the prospects in the world to someday be accepted as a real, if you will, currency. But until it reaches that point where I'm doing anything more than just speculating that somebody else, if I would take it from me in payment of a bill or something, to me that's not. I can't give that much credibility other than as a pure speculation. In which case, it doesn't have any real value over and above what a tulip bulb had 400 or 500 years ago when in the tulip mania thing. In other words, anything whose only value, whether it's stamps or even gold, only has value to the extent that there's a market where somebody else will buy it from you for hopefully more or the same as you paid for it. To me, that's not enough for me to invest in it. We just moved from one home to another. We downsized a little bit. And so I sold our old house. And after I paid off the mortgage, I had, a few $100,000 that I'm still sitting on because I'm trying to decide how to invest it and what to do with it. But if the people I was selling the house to had said, "Oh, we're not going to pay you dollars, we'd like to pay you in cryptocurrency of some sort," I wouldn't have even considered it, unless there was I had some assured place that I could take that cryptocurrency and make sure and convert it to dollars or convert it to or buy another house with it or something. And until until cryptocurrency achieves that, I can't take it seriously. I mean, I think it's interesting. If I had so much money that I could speculate on all kinds of things, I might buy some of it just as a total speculation. The way I do some of those ETFs, some of the covered call ETFs that you mentioned that I don't fully understand, I've still taken what I call toe in the water positions in, just to see how they work, and to get the weekly dividends and everything. But I'm not at that point where I would put money into, unless I had enough of it that I had money to burn completely. Cryptocurrency is not at that real point yet where it has authentic value behind it all the time that I could sort of take seriously.
Interesting.
Maybe
Okay.
I'm call me a financial curmudgeon, in that regard, but that's still where I am.
Yeah. Well, I think you took the Warren Buffett view, where I think he makes the same case like you said about gold as well. He compares it to those tulips back in whatever it was that time where they were going up, and it was a speculative market. I agree in one sense. I do. No, this is just me personally. I do see the potential that it could be used as a currency. I'm not a Bitcoin maximalist. I would only ever invest in it if, with a covered call. So there's actually Bitcoin covered call ETFs now with 25% yield. You got YBTC, you got BTCI from Neos, Roundhill has one. The same guys who do QDT, XDT, they have a Bitcoin one as well. So, if it's, I'm a covered call maximalist. I wouldn't say, but I like Bitcoin because I like the general premise of it. I think, like you said, it's not technically backed by anything, like no government, but I think the whole point is to get the government out of that and have the people back up the network. So I'm still learning about it as well. I'm not fully immersed in it as well, but it's definitely been the top performing thing I had. And what I had is Bitcoin with covered calls in one account, and MicroStrategy stock with covered calls in another account. They both done really well. So, all right, cool. So let's move on to just some, if you don't mind, a couple of member questions here. And just a reminder that if you guys want to participate in future Q&As, ask experts and fund managers questions, just sign up to the PII Inner Circle. Just hit that little join button. So let me see. Let me bring up my screen here. I guess I'm going to have to share. Oh, no, here it is. Okay, perfect. Can you see that, Stephen?
I can. It's blank at the moment, but
should be coming up.
Oh, yeah. Yeah, I see it refers. Oh, I see. They're written questions.
Yeah.
Okay.
So the first one this is from Covered Call ETF Investing, who is my friend Jordan, who also has his own channel that focuses on covered call ETFs specifically. Shout out to him. Make sure you guys subscribe to his channel as well. So, would Steve ever release a second edition of the Income Factory with commentary chapters that would have written contributions from people like yourself on passive income investing, talking about more covered call ETFs? So have you thought about another book, another version, update, or anything like that?
I've thought about it. My book is still selling like it's a kind of a cult favorite, I guess, on Seeking Alpha and among people that have learned about my Inside the Income Factory service on Seeking Alpha. I'm spending a lot more time and actually generating a lot more revenue from my Inside the Income Factory service than I am from the book right now. I'd be happy to reissue, do a second issue of the book, update it. If McGraw-Hill, the publisher, were interested in publishing it, and such an issue I could bring in other people and ask them to do commentary on it. That would be a somewhat different book, but it would be a very interesting one. But I'd have to find a publisher who was interested in doing it. It would be a fair amount of work to assemble other commenters and to update my portfolios. And most of the people who would be potential buyers of the book, and a book, no matter how updated it is still out of date within a few months as far as its portfolios. So I'd still be asking probably the same people that be buying the book to subscribe to my Inside the Income Factory in order to get the updates. And I suspect most people would rather get the updates routinely and regularly by subscribing to the Seeking Alpha service than to buy a book that still might be out of date in 6 months as far as its actual model portfolios.
Okay, fair enough.
But
Food
it's a
for
good
thought, I
idea.
guess. Okay, perfect. Next question. I'm sure it's a cut very probably. I'm assuming one of your number one questions you get. Can the income factory work for younger investors in their 30s, or is it best for retirees? I definitely have a strong opinion on that, but go ahead.
Yeah, well, we talked about that earlier. As I say, math is math. I think a thoughtful investor who's 30 years old and wants to put money aside and invest it and probably add more money to it over the years, but hopefully leave it there, not play around with it a lot, and just let it grow. Whether they were talking to me or to a John Bogle or Warren Buffett or anyway, they'd probably be told, make your investment decision, what you want to, how you want to invest, and then forget about it. Don't try to time the market. Don't look for
Yeah,
entry points. Don't go in and out over the next 30 years because you'll hurt your long-term returns. So somebody who's prepared to do that, they should either, invest in index funds or large cap funds or a covered call income strategy like yours and just reinvest in
just
compound,
drip. Yeah,
or do it as an income factory. But as we showed before, if you're getting a 9 or 10% total return on it, you're going to end up at the same place when you're 65. And the key is to just pick the one that, after you do your sort of due diligence, pick the one you're most comfortable with and then stick with it.
yeah, that's a great statement. I feel the exact same way. And this is why I always tell people I try to push always look at the total returns of something. That is the
Mm-hmm.
ultimate truth, not the stock price, right? Because, like you said, math is math. But if you're only looking at stock charts, you're looking at the price return, not the total return. So, obviously, you got to look at the total return. And, like you said, whether you get it with income being reinvested or passive index funds, it'll come out to the same thing most likely after a number of years. So last question was, does he own any Bitcoin? But I'm assuming the answer is no.
No,
So no, okay.
I don't
Um,
buy anything I don't understand.
Fair
No.
enough. That's a good, good mindset. Last question: given the current market environment with changing interest rates, inflation, increased geopolitical uncertainty, how can investors strike a balance between maintaining a long-term mindset and managing the psychological stress of short-term volatility? This is a good question and statement that I feel more inexperienced investors have, and that comes with time. And he says, or she says, I'm not sure, especially when faced with conflicting advice. I hate this conflicting advice to stay the course, like you just mentioned, right? Stay the course or adapt to changing conditions. What would you say to that? This is more of a, how to maintain that mindset. And what do you say to people that, so you got one camp that says, like Buffett, just buy the S&P, stay in it. Like we say, just stay in it long term. And then you have others, if you go on MSNBC, they're always what this and that and go get it out of this sector. This sector is going to be good. How do you manage that, do you think? What would you tell this investor?
Well, I manage it by investing in my income factory. I developed the income factory because, like everybody else, I couldn't figure out how to manage conflicting advice because I don't know anybody who has a crystal ball who knows what's likely to happen. I mean, our economy's been doing very well. The stock market's been doing very well, but we don't know whether our new administration, while they may say they like the stock market in general, we don't know whether they're going to do things like tariffs across the board or depopulating the parts of the country that the agricultural uh, industry is dependent on, or that other parts of our construction industry is dependent on. So we don't even know, what, as they said, conflicting opinion. We don't know whether the market's are going to boom, or whether we're in for a downturn or a recession, which is why I think whether one does it through covered call strategies or through high yield credit or through a lot of basics like utilities that are going to have to continue to pay their dividends and everything, no matter what happens, because we're going to need utilities and we're going to pay for them. And no matter what, that's why they're called regulated industries.
Yeah.
So, yeah, I would say anyone who isn't confident enough to just invest in an index fund for the next 20, 30 years and forget about it and invest like Rip Van Winkle, uh, because they're going to be worried about watching it go up and down, I'd say then go for a high yielding strategy where you're going to continue to be able to collect your 8, 9, 10% or more per annum and reinvest it. And if the markets are going down and you continue reinvesting, you're actually making more money. You're growing your income faster when markets are down because you're reinvesting at bargain prices and higher yields. So to me, that's the only way I really know to sleep well at night through markets that may be going up, down, and you don't know which way, because until we have crystal balls, uh, I don't know any other way to kind of sleep well through volatile markets than what we've described.
Yeah. Yeah, for sure. I mean, sometimes it feels like I'm talking to myself in the mirror listening to you. It's incredible. I agree
Well,
with everything you said. I mean, I'm definitely in that mindset. Nobody could predict anything. I want to be protected and sleep well forever. So this is, you chose the income factory with the credit funds. Equities with covered calls. And I am actually always tell people I'm looking forward to the recession, the market crash, the pullback, because like you just said, you're gonna buy more cheaper. In the long term, you'll actually be better off. And if it does crash 10, 15, 20, 30%, yes, I'll see the account value in my account go down by 10, 20, 30%, but I don't care because I'm not drawing it out. I'm just living off the income or reinvesting a portion of it. So I'm actually more excited because, as you know, when you buy cheaper shares, the yield is higher. So then when the markets recover, you're in a better position.
yeah, just
Um,
to, yeah, and I agree. And 2022 was a terrible market for stock investors, but my income went up faster that year than it had ever before
of
because I
course.
was reinvesting and compounding at lower prices. And again, the income factor is just a clever name I came up with for my strategy. But had I discovered ETFs, covered call funds, and I do invest in covered call funds. They're in our model portfolios. They're mostly closed-end funds run by the Eaton Vances and BlackRocks and others that have some very well-established covered call
Yeah,
closed-end funds that have been running for years.
that's true.
Uh, so, I mean, if I had discovered your strategy 15 years ago or 10 years ago, I might have called it the income factory. I mean,
Yeah,
I took the name income factory because it expresses so well this idea that you regard your portfolio as a factory. And, Ford Motor doesn't worry about what its factories are worth because they're not selling factories. They just make sure their
produce.
factories keep producing income. And, you know, I'm just, I was clever enough to go out and get a patent, a copyright on the name income factory, but it could apply to your strategy or any strategy that uses high income securities that goes for cash income and then create your own growth with the cash instead of relying on capital gains. So we're
Exactly.
all we're all in this we're all in this together, really.
Exactly. And don't be too hard on yourself about the cover call ETFs because 15 years ago they didn't exist. Even 5 years ago in Canada. So, just a bit of background. I mean, in the US, I think the first ones, let's say the first mainstream one, QYLD from Global X, I think it's 2011 came out. They all started coming out 2010, 2011, 2012. That's when they started the covered call ETFs coming out. So let me get this straight. The covered call strategy is not new at all. That's just a
Right.
very basic,
That's right.
boring option strategy. But to combine it in an ETF form, that only started in 2011. And in Canada, they had a lot more than in the US. US, they had QYLD, XYLD. They just had the index, the three indexes, or just the Nasdaq and the S&P. Now, of course, it's exploded on the US. We not only have, dozens of S&P 500, Nasdaq 100, Russell 2000, but also sector specific ones, single stocks. Now it's just crazy. But even in Canada, I mean, they didn't exist 2011. We had maybe four or five, maybe a dozen of them, and they were all sector based.
Hmm.
So when I started this 5 years ago, there wasn't the amazing products that are now, which, in my personal opinion, I feel the best cover call strategy is doing it on an index fund, because what's the best growth, classic growth strategy? Passive index funds, right? Automatic diversification, market cap weighted. So you got always the best companies that the indexes change. Just adding a cover call strategy to that, I think is genius. So, but I recommend, we'll wrap up now because I know you got to go. It's almost been an hour, but if I could just leave you with, I recommend definitely looking into the equity covered call ETFs. I think they're right up your alley. And it's a way to just stay invested in equities while getting that income. So you got better performance, in my opinion, over time. So, yeah, so Stephen, I hope we could do this again.
Great.
We're on the same page with a lot of stuff. So I really appreciate you taking the time coming on, and tell my audience a little bit if they want to follow you, if they want to, I'll put the links in the video description below, by the way. Tell me about your Seeking Alpha real quick,
Well,
membership there.
yeah, I started writing for Seeking Alpha 20 years ago, but they invite writers to create their own subscription services on Seeking Alpha that Seeking Alpha hosts.
Okay.
So I started one called Inside the Income Factory about 5 years ago. They have 144 services that they host, and mine, to my great surprise and delight, is now number 8 out of 144. So we've grown a lot, and I'm finding that much as people enjoy having the model portfolios that I update every month, I think what they mostly enjoy is the chat comment. It's our own little online group where the 1,500 or so subscribers, they make chat comments, they ask questions. The old timers who've been on for 3 or 4 or 5 years and have been reading me for years will answer the questions of the newbies even before I get to read them sometimes. So it's a wonderful environment. People are helping each other. And I think that's what they seem to appreciate
Yeah.
even more, because I've found that everybody who subscribes to any of these services on Seeking Alpha, I guess, gets a 2-week free trial subscription, at the end of which they decide, well, thanks, but no thanks, and they go their own way and forget it, or they re-up and subscribe. And I've been number 1 for the resubscribers. In other words, people who choose to stick with it after the 2-week trial is up. I'm up to like 55, 60%, whereas the average is like 10 or 20%. So I've been the number 1. So that makes me feel that we're doing something right. And I really
Yeah.
appreciate the support of my subscribers, has been just wonderful.
Yeah.
So yeah, welcome. Anyone can try it for 2 weeks. If it's not their cup of tea, no hard feelings. We're glad you tried. So you
Yeah.
just, yeah, Google me, Google Seeking Alpha and my name, or just Google my name, Stephen Bavaria, and it'll pop up. There'll be links for it.
Yeah, it's so funny what you said, because the same thing is happening to me with our group. We got a Facebook group of, I think, over 14,000 now. It was growing so quickly, we had to make it private and start limiting the people coming on. And now it's like, the first year or two, I had to answer every question, but now you have all these senior guys that have been with me, senior people for a long time, and they answer questions before I could even get to it. It's just fantastic. It's a very loyal group,
That's
because
great.
this stuff is important, man. It could change your life. It could take a big load off your shoulders. I mean, to have financial health is like everything. If you don't have that, you're in trouble. I mean, and to get that knowledge to control your finances, you don't have to give the control to someone else where you have no idea what they're doing or what's happening is a big load off. So
No,
it's a good thing.
I'm congratulations on what you've achieved, and
I appreciate it.
thank you for bringing me on. I have the same experience where people tell me, you've changed my life. I invested another way for years and worried about it. Now, since I've switched to your thing, the money rolls in every month. I reinvest it, or if they're retired, I spend some and reinvest the rest. And I'm
It's incredible.
sleeping better. They keep telling me
Yeah.
people sleeping better than ever before at night, not worrying about all the BS going on
Yeah.
out in the larger markets. So,
I'm experiencing the same thing. I got people that actually have flown to Panama in person just to tell me that, hey man, you know, they buy me lunch, they buy me supper, and they say, I retired 10 years early because of you. I can't think of a better comment that makes me feel great when I hear that. You changed my life. I get those all the time. I actually started saving all those emails and comments now because you know,
yeah,
it's always good to go back and read them because I started getting so many. It's incredible. I mean, very
yeah.
grateful to my subscribers as well. I feel the same way, and it's a good thing. It's overall a good thing. So,
Oh,
as
that's good.
yeah,
When I wrote
Stephen.
my book, I took a whole bunch of subscriber comments and
Uh,
actually put them on the first 2 pages of the book. You know, people just telling me
Good
things like
idea.
this. That's what yeah. When you write your book, you can do that.
It's a
You live
long term.
you
It's
live
a
in
long term
Panama.
plan. Yeah.
You live in Panama there.
Yeah. We live in we you know, born and raised in Canada, Montreal,
Oh,
Quebec, Canada, but we moved to once we retired because you know because of this strategy. So this is why I have not only the I live through it. I live this investment strategy for years now. So I have a lot of experience, and people have, you know, by sharing the story, and people have gained the courage to do the same thing. I got a lot of couples, same situation, retired in their 30s and 40s. It's fantastic. But yes, we live in Panama now, permanently for almost 3 years now. And we just run this YouTube channel, and we have fun doing it. That, you know, knowing that it helps so many people. So yeah, writing a book is definitely in our long term. We still got a few other things to do, but we definitely thought about it. Definitely it'll come true, and I'll use that idea you had. I'll start saving those comments, and I'll put them at the beginning of the
that's right.
book. I think it'll be cool.
Yeah, thanks. And if I ever get back to Panama, then we'll have a session in person. I
For
lived
sure.
I lived there and ran the Bank of Boston 40 years ago or so, and lived in Altos del Golfo,
Yeah,
which
yeah,
was
rings a bell.
yeah.
Rings a
Anyway,
bell. So
wonderful. Well, congratulations again, and thank you.
I appreciate it. It is true. You did. We talked about it in the previous Q&A, which I recommend my audience, if in case they missed it, go watch it. We're basically your whole story, and you actually lived in Panama. I thought it was quite funny, quite a cool coincidence there. But all right, Steve, I'll let you go. We'll do this again another time for sure. Take care, my friend. Thank you.
Thanks, Adrian.
Have a good
Okay.
one.